Hi everyone, Brian here. In today's video, I'll explain what I-bonds are, who can buy them, how to buy them, along with the strategy used to determine if you want them for the short term or for the long term. Simply put, there are a lot of people out there that don't know the basics about I-bonds, so I felt it was important to make this video to give some basic information on the topic. In case you are not familiar with Series I bonds, they are U.S. Treasury savings bonds that earn interest from a fixed rate combined with an inflation rate. And as you can imagine, when inflation begins to get out of control like we see right now, then I-bonds become very attractive. In order to do this topic any justice, I need to cover 5 areas of I-bonds so you can be better informed. To begin with, I need to explain what Series I savings bonds are, and then I can cover who is eligible to buy them, where to buy them, and then I need to discuss the limitations of I-bonds. Once that foundation is established, I can begin to discuss the strategies behind I-bonds. I'm going to start by defining I-bonds, which is essentially a mini loan you are giving the government where the bond is issued directly from the U.S. Treasury. I-bonds are specifically created to protect your investment from inflation, which right now we all need. With I-bonds, you are allowed to purchase $10,000 worth each calendar year, but you can also obtain another $5,000 worth of I-bonds via your tax refund, bringing it to a total of $15,000 a year. And of course, there'll be some people out there that'll state, "But Brian, if you have a tax return of $5,000, then you aren't managing your taxes correctly." And those people are partially correct. In a normal year, I would agree with that statement. However, in a year like we have today, where the stock market has taken on some serious losses, then many people will utilize the strategy of the stock loss harvesting. And this is when you actualize the losses on your investments by selling them and then taking the loss on your taxable income, and then of course reinvesting the money later. Overall, this would result in having a larger than normal tax refund. It's a strategy that I use, and I would expect many people out there to have a larger tax refund in a year following a stock market decline. Now, getting back to I-bonds, a key way that they differ from Series II bonds, you know, the ones that your grandparents got for you as a kid for your birthday, well, they're different based on how the interest rate is determined. The I-bond interest rate is made up of a composite rate based on a fixed rate at the time of purchase and the inflation adjusted rate in this equation right down here, whereas the EE bonds have a fixed rate that never changes. And the overall composite rate for an I-bond is set twice a year in May and November, where that rate is set for a 6-month period. For example, if you buy an I-bond in December of 2022, the rate is 6.89% because that's what was established in November of this year. And after 6 months of holding the bond, the rate will change based on what the newly set composite rate is, which happened to change in May. Next, I need to cover some details and limitations for I-bonds. One major hurdle is that you must hold an I-bond for a minimum of 1 year before cashing it out. Even then, if you cash out before 5 years of owning it, you do take on a penalty of losing the last 3 months of interest. For example, let's say that you buy an I-bond and then decide to sell it right on the 2-year mark, which is 24 months. But instead of getting 24 months of interest, you only get 21 months worth of accrued interest. This is because of the 3-month penalty for cashing in before the 5-year mark. Overall, an I-bond hits maturity at 30 years, but it can be cashed in at any point after the initial first year. And one of the most appealing parts about I-bonds is that they are only taxed at the federal level. So that means state and local taxes are not impacted your I-bonds in any way when you cash them in. Now, I know what you're thinking. You buy an I-bond to loan money to the federal government. The federal government pays you interest based on that loan. But when you cash in the bond, the government now taxes you on the interest that they paid you on the loan? Yeah, that's kind of a circular reference. They technically get a loan for well below the advertised rate, but overall, you're still getting a very safe investment. The next section to cover is who can buy I-bonds. In order to purchase an I-bond, you must have a social security number and meet one of the following criteria. And that is, first, be a U.S. citizen, even those that may live abroad. 2, be a U.S. resident. And 3, a civilian employee of the U.S. government, regardless of where you live. Now, if you happen to be a person that wants to gift I-bonds, you certainly can. However, the recipient, even minors, must have a Treasury Direct account, and you'll need the recipient's account number and their social security number in order to gift the I-bond. One caveat is that children under the age of 18 are not allowed to set up their own Treasury Direct account. A parent or guardian must set up the child's account and link it to their own account before you can gift an I-bond to them. The gift goes against the recipient's total allotment of $10,000 worth of bonds in a calendar year. Now I'll move on to how you can purchase I-bonds, and I'll break it to you quickly. There's only one option. You can only purchase these bonds directly from the U.S. Treasury website. It takes about 10 minutes to set up your account, and then you can make the purchase of anywhere between the minimum of $25 and up to a total of $10,000. And you can even purchase them in increments of pennies, so you could literally buy an I-bond for $25.03. I'm not sure why you would, but you certainly could. You have the option to purchase either an electronic version or a paper version of the bond, but the paper version can only be purchased when you leverage your tax return to buy buy the I-bond. And paper versions of the I-bonds cap out at a total of $5,000. When you go to Treasury Direct website, there is a huge button on the side guiding you to set up your account. When you press this button, it lists out 3 steps you'll be taking where you can pick your type of account and then choose your password and personalized image. When you move on to the next page, it defaults to the individual account. And for 99% of you, this is exactly what you're going to want. Now, looking down further, you see that you can set up separate accounts for LLCs, corporations, trusts, and estates. You're allowed to buy the maximum amount of I-bonds for each account, like your personal account and for each and every LLC or trust that you may have. Just keep that in mind if you want to buy more than the $10,000 cap per individual, and if you have an LLC, you can also purchase another $10,000 under that tax ID. Moving on to the next page, you can see that it has the normal account information that you would expect in setting up an account, ranging from your name, address, and also your social security number. The one item that takes a bit of extra time to fill out is your banking information with your account and your routing details. And this is in order for you to purchase the I-bond, but it's also for you to have a location to deposit your asset when it's sold. Once completed, Treasury Direct will then guide you to log right back in. While you begin the process of logging in for the first time, it will then send you an email with a one-time password since they don't recognize your computer. Me personally, the Treasury Direct website never recognizes my computer, and I have to get a one-time password sent to my email each and every time that I log in. Make certain that you keep all of your login information in a very safe and secure place. I'll warn you, it is common for people to get locked out of their account with Treasury Direct, and you do not want that to happen to you. If your account does get locked out, then you'll need to fill out physical paperwork and then mail it into Treasury Direct. And the whole process can take several weeks to be able to give you access to your account again. So make certain to keep your password information readily available and in a safe place. And when you do log in, it shows you the picture that you chose when you set up your account. And the reason why they do this is to make sure that you aren't getting scammed or pushed to some other website that isn't really Treasury Direct. At this point, you're going to need to enter your password using your mouse and picking letters on the screen, not with your keyboard, and certainly no option to copy and paste your password into the login. I made the mistake of picking a highly complex password, which is a bit of a pain to enter manually, but at least I know that I'm going to be very secure. Now that you know more about I-bonds and how to buy them, I'm now going to cover the strategies on why you would buy them, when to buy them, and how long to hold them. For me personally, I see 2 main strategies in buying I-bonds, and that involves a long-term and a short-term approach. As I mentioned before, the equation for series I-bonds is comprised of 2 major elements, and that would be the fixed rate in conjunction with the inflation rate in this equation right here. With that in mind, a person will want to buy I-bonds when one or both of those variables are high. Let's go over the short-term strategy that I use with I-bonds. We all know that inflation fluctuates over time, and I-bonds are not attractive when inflation is low. And since the average inflation over the past 30 years has been 2.47%, there haven't been many moments where inflation was high enough to warrant having an I-bond. But in our current state of high inflation, the return on I-bonds as of November 2022 is 6.89%. And I only expect the I-bond rates to be high for probably another 12 to 18 months. The reason that I see I-bonds being a short-term strategy today is because I expect the inflation to drop sharply starting in the spring of 2023, which means that the I-bond rates would begin their decline in May of 2023. There's a point where the interest rate on the I-bonds will be so much worse than the returns on stock that I would choose to sell the I-bonds and reinvest the money. Granted, the moment that I sell them, I'll have to pay the federal tax on all the interest that I made, and I'll lose on the last 3 months of interest because I didn't hold on to them for the full 5 years. But I would only sell them once the rate has dropped to a level where my opportunity cost for reinvesting becomes too high. That happens to be my short-term strategy, and I think it's important that you now understand my long-term strategy that you really need to keep in the back of your mind when it comes to I-bonds. Like I had said earlier, I-bonds are comprised of the inflation rate and the fixed rate. If the fixed rate happens to be high, like it was in May of 2000 at 3.6%, then you may want to hold the bonds for the full 30 years. That same bond bought in May 2000 would have an interest rate of 13.39% as of May 2022. In fact, the average interest rate on an I-bond bought in May 2000 is at just over 6%. Simply put, if the fixed rate is high, then I would implement a long-term strategy for I-bonds. Just something to keep in the back of your mind. Overall, series I-bonds are meant as another tool in your diversified toolbox. Overall, I hope that you learned something new and you're able to get some value out of this video. Once again, please be safe with your money, and thank you so much for watching.